Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Kevin Davitt, Head of Index Options Content at Nasdaq, as well as Eric Metz, CEO of SpiderRock Advisors. They join me to discuss how fixed income versus equity volatility compare and the growing usage of options in portfolios. Gentlemen, it's great to see you as always. Welcome back to Trade Talks. And Eric, let's talk about the volatility that has come back into the market over the past couple of weeks. How do you typically view market volatility through the lens of index products? Explain to us how that process works.
Yeah, I appreciate it, Jill, and thanks for having me. Q1 was a fairly docile bull market, and volatility was fairly dormant. And it's almost like you flip the calendar quarter, from March to April, and things changed almost overnight, right? And so obviously the scrutiny here is on Fed and data dependency, and the CPI figure a couple days ago, I guess maybe a week and a half ago now, kind of threw some folks into a tailspin, and noticing and having the expectations of the Fed, reducing the probability of reductions later this year has really caused equities to I'll call it sell off, but also have volatility start to percolate. We were close to nearing the floor over the last couple of years, throughout the Q1, and so I view this as nothing spectacular and kind of more reversion to the mean from a volatility perspective. But investors get complacent, and the equity bull market's long in the tooth, and so seeing a little bit of interest rate getting repriced into equity markets is not surprising. And I think it'll be interesting here in the weeks to come to see if this sell-off has any follow-through.
Right. And Kevin, let's get your perspective here. I know you spend a lot of time in the index space. You're looking at the VIX, you're looking at VIXen. Do your thoughts align with Eric, with your work within the index space and looking at volatility indicators there?
Yeah, they largely do, which maybe makes for less interesting conversation. But I would argue that bigger picture, we're more back in a much more normal volatility environment from the equity index lens. Now, we're going to talk a bit more about fixed income, where that has percolated and has remained relative to history somewhat higher for the past couple of years, and I think justifiably. But from a big picture lens, like not a trading day-to-day lens, volatility with the VIX around 19 and VXN in the low 20s is fairly normal. And Eric mentioned the complacency that I think did set in Q1, and having this hindsight bias where there's been a lot of talk about how long it's been without close over close move in the S&Ps of greater than 2% on the downside. And I looked back, and so I focused primarily on the Nasdaq 100, the last 2.5% decline in the Nasdaq 100, again on a close over close basis, was September of 2022. And I think it's very normal for volatility to move towards those kind of like historic low levels in an environment like that. The market is now repricing risk, this higher for longer, and as well as the geopolitical tensions that kind of continue to percolate. It was interesting on a more short-term basis to see price action in indices and in volatility markets overnight with news coming out of the Middle East. I think also that the fact that so much of this happened this month, and like Eric mentioned, post CPI, is a little bit interesting because the Fed funds have been pricing out cuts since the beginning of the year, and it seems like equity markets are now playing catch up. We had a standard index expiration this morning, and to Eric's last point, I think it will be very interesting to see whether there's a continuation out to the end of April and maybe beyond, or if this might be a sort of short-term local bottom. And I'm certainly not advocating one way or the other, but I think the volatility markets will be indicative going forward.
Right. Well, Eric, at the end of the year in December, certainly the equity markets, they were hinging their bets on 6 to 7 rate cuts. And the fact that we made all-time highs without that, and perhaps not even getting a rate cut in 2024, I think the equity market has digested it relatively well.
I couldn't agree with that more. In fact, I think equities are almost priced to perfection, and to the point where like it was nerve-wracking for a lot of folks, right? This equity risk premium here is real, right? The front end of the risk-free rate now is nearing 5. And with long-term equity forecasts, I mean, if you look and poll Wall Street, I think long-term equity forecasts, are somewhere between the 6 to the 8% range in the S&P and the 8 to 10% range for growth in the Nasdaq. So you take that with a front end risk-free at 5, and valuations are in scope. And so as that interest rate pricing starts to flow through into everybody's equity valuation models, you will see some turbulence, and there will be some jockeying back and forth as the data comes through. But I think everybody just needs to have an appreciation of how far equities have come from the October lows of last year. I mean, it's one of the largest bull markets in a short window of time on record. And when you get that, and then you get some interest rate scrutiny, what was priced in, I think the jury is out. But at the end of the day, a little sell-off is healthy.
Right. Kevin, let's talk about bond volatility and how it compares to equity volatility. Perhaps let's take a step back for a moment here. We typically talk about equity vol on the show. If you could just give us a high-level overview, Kevin, of what bond vol is, what you're looking at.
Sure. So generally, again, I tend to focus on indices, and I'm options focused too. So forward-looking measures like the MOVE index is what I generally use as my benchmark for forward-looking bond vol. And the recipe or methodology there points back to Harley Bassman at Simplify, who you've spoken with. And it is VIX-like in its construction, in the sense that it's using 1 month bond options and giving you an indication of what the market's pricing as far as forward volatility in that market. Now, as I mentioned in the first part of our conversation, relative to history, indicators like the MOVE index have remained higher, and then compared to equity vol, it arguably looked out of line. But when you talk about a rate path and an unprecedented rate hiking cycle in terms of how far they moved, particularly off of a low base, it's been justified. What we've seen more recently is that realized vol on the equity side has picked up, and that has converged the relationship. So just to briefly recap, generally what I focus on is the MOVE index. It is very VIX-like and VXN-like in its construction, except for the inputs being treasury options as opposed to S&P options or Nasdaq 100 options. And the gap between bond vol and other sort of cross-asset volatility has been narrowing as the latter have picked up, and bond vol has kind of remained. The MOVE index right now is right around 115. It was, if memory serves, around 160 at its highest a couple of years ago. So it is elevated still relative to history and other markets, but I would argue that is a justified premium.
Right. And Eric, it's interesting, what we also saw as well, the equity market was interpreting what was happening in the macro very differently than the bond market did. It was almost like it was, two different markets or two different ways of interpreting it, really played out in 2023. And we've seen that in 2024 as well.
Yeah, I think the correlation of how rate vol are flowing into the equity markets is definitely something that's being overlooked right now. To your point, Jill, I think were equities priced to perfection? I think time will tell. What the Fed's going to do is going to be very reactionary to the inflation data that continually comes through. But at the end of the day, like, which tail is wagging which dog, I think is up for debate. And so when you think about what rates should do, if the entire equity rally off the October lows was with this notion of Fed cutting, and now that rates are here for longer, like, you would see hopefully some of the inverse of that to come to fruition here. Now we're barely off the highs still. And so if that rate repricing through these equity valuation models flows through without an expansion in multiples, without an expansion in earnings, you will see some equity sell-off if that continues.
Right. Let's talk about the growth of option overlay strategies, because there really has been a lot of growth, and we're seeing advisors just employ it more within their strategies.
I think.
Oh, I'm sorry, Eric.
Go ahead, Eric.
I think there's a plethora of trends here. I think number one is just the demographics of where private wealth exists, right? And part of the usage of options and a growing usage of options is to protect portfolios, but it's also to protect portfolios in a tax-conscious investor. And so the biggest value prop that this trend has to the investor is being able to de-risk an equity portfolio and not incur an instantaneous tax friction. And our clients are demanding that left and right. And so when you get a little bit of turbulence, a little bit of equity sell-off, it reinforces the need for risk management and the scrutiny on protection. Everybody has an insurance policy on their home. Everybody has an insurance policy on their car. Very few have insurance policies on their largest asset. That's their equity portfolio. And when you incorporate that, coupled with options education, coupled with the trends in technology and user interfaces and just access, you're getting a lot of forces that are coinciding, which is driving this growth trend.
Right. Well, Kevin, the question is, does that potentially impact broader market volatility?
That is a point that's gotten a lot of attention in the past couple of weeks, or really the past year. So on the one hand, I understand it because there's now, so recent Goldman research pointed to about 250 funds and roughly 160 billion in assets under management that systematically trade either equity or index option strategies. Now that number, the AUM number, has more than doubled since the beginning of 2023. So that's big growth, and that tends to capture attention. Going out a little, looking through a broader lens, and something Eric has seen since he started SpiderRock, if you go back to 2017, the AUM in these types of products were essentially zero. Now, there has been regulatory changes since then that I'm not inclined to go into. But when a whole bunch of money flows, whether it's towards crypto or towards meme stocks or what have you, it garners attention. Now, on the sort of more level-headed side, we're talking about generally strategies like covered calls. And the research that I'm pointing to argues that these funds on average have a beta of about 0.6. So less than just your general equity exposure, significantly less. If you look in terms of just volumes generated by these types of strategies relative to the markets that they're being executed in, it's very small, something like 3% relative to the S&P complex. It's a little bit higher in the Nasdaq 100 complex, but overall, very, very small relative to the broader ecosystem. One other point that I think Eric knows full well and he can speak to is that typically these strategies outperform during market declines, and that money tends to be stickier as a result. I think the strategies will continue to evolve, that we will continue to see them come to market. Some will do extremely well, others won't. But there is plenty of capacity, at least in my opinion, in these markets. And generally, the strategies have a lower beta. So I think there's less likelihood of huge outflows. If you don't mind, I've seen Eric speak about, and you mentioned the expectations for potentially lower broad market returns and the expectation looking out longer term for continued higher volatility. I'm curious what sort of metrics you or your clients point to there, and whether you think these types of approaches become increasingly attractive in a stickier vol environment, or if we move back towards like the behavior we saw last year, whether they'll be less attractive.
I think there's two threads to pick up on there, Kevin. And if you look historically at just large cap equities, S&P, and large cap growth, Nasdaq, your compounded annualized returns over the last decade are 12 and almost 16% respectively. If you look forward at every Wall Street bank's research, and even my partners at BlackRock and their capital market assumptions, like forward-looking equity returns in those two categories are like 50% of that. And simultaneously, we're off the zero interest rate policy from the Fed, and in a very, I'll call it inflation, stagflation debated market, with rates and vol really increasing. So you add all of that up, And what does that do from investor behavior? What does that do to the consultant arena? What does that do from an academic's perspective? It forces you to think about ways to, manage vol, one, increase expected returns if equities aren't going to deliver upon that, two, where do option strategies fit in the cross section? Right squarely in the middle of those two topics. And so these demands and trends, they're not coincidental. Like I think they're very tactical in the why now. I think they're very strategic in the 3, 5, 10-year cycle that we now are looking forward on. And again, what has happened through this whole time frame? Access, education, proliferation of I'll call it prudent risk management, I think has been the driving force of all of these things.
All right, Kevin, Eric, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, guys. Thanks, Jill.